Hi, and welcome to the Stefan Livera podcast, a show about Bitcoin and Austrian economics. Today, for episode 157, we talk about some of the bad options on the menu for dealing with the fiat debt problem and why buy Bitcoin. This show brought to you by Kraken, one of the world's leading Bitcoin exchanges with a really high-quality platform, offering one of the most liquid platforms on Earth for Bitcoin trading with high trading volume and low fees. Kraken offer 24/7 support. They're consistently rated the best from a security standpoint, and now it's even easier for active traders and institutions to avoid friction when executing orders with the launch of 9 new foreign currency pairs, a combined offering that allows clients to be more agile and sophisticated. Don't forget, there's Kraken Pro mobile app delivering all the security and features you love about the Kraken exchange. There's the Kraken OTC desk. There's Kraken margin up to 5 times leverage and Kraken futures up to 50 times leverage. Go and sign up at kraken.com or find Kraken Pro on Google Play or Apple App Store. Next up, Unchained Capital, Bitcoin financial services done with multi-sig. Are you looking out for the security of your Bitcoin private keys? Are you using something like collaborative custody? With Unchained, you can have a 2 of 3 multi-signature vault. You can keep 2 different keys, say 1 Trezor, 1 Ledger, and the third key can be held by Unchained. And that's a good way to help secure your Bitcoin and split up your keys. If you need liquidity, if you need USD, you can put up some Bitcoin as collateral and borrow against it. It's stored on-chain, dedicated multi-sig, and it's never rehypothecated. Unchained are producing really awesome content and open source contributions such as Hermit and Caravan. You can check out your multi-sig and test it on there. I think you'll enjoy partnering with them. Go and learn more at unchained-capital.com. Next up, Swan Bitcoin. Bitcoin is better money, and you want to stack it regularly without manual processing, right? If you're in the US, look up swanbitcoin.com. You can link any major US bank account via ACH and auto buy weekly or monthly. The Bitcoin is delivered to your wallet or stored with a licensed and regulated custodian. Swan Bitcoin's focus is on education and Bitcoin advocacy. Jan Pritzker, author of Inventing Bitcoin, is their CTO, and Brady from Citizen Bitcoin is head of education. I'm involved as an advisor with a small equity stake also. So there's givebitcoin.io for your Bitcoin gifting, and go to swanbitcoin.com for your automated Bitcoin stacking. Last but not least, CipherSafe, cyphersafe.io, producing the CipherWheel product. Have you invested in a Bitcoin hardware wallet, or are you using a multisig with multiple hardware wallets? Well, you've got some 12 or 24 word BIP39 seeds that you need to back up, and you need to back them up in a way that's fireproof, waterproof, rust-proof, pet-proof, and tamper-evident. The CipherWheel is compact, comes in a wheel shape, masks the words of your seed, and it's got a padlock tamper-evident seal. Make sure that you or your loved ones have access to your Bitcoins if an accident occurs. Orders are going out now. Go and check out cyphersafe.io. This is a great episode continuation on from my earlier episode 109 with Preston Pish. And Andy is a CFA and CFP who has been writing about Bitcoin from an investment standpoint. And we have a really interesting conversation in this interview around the fiat money debt problem and the bad options on how we get out of it. I think it's actually quite relevant given some of the recent action on the market as well. So I'm sure you will enjoy the episode. Here is the interview. Andy, welcome to the show.
Thank you, Stefan. Glad to be here.
So Andy, had the chance to meet you at Bitcoin 2019 at the conference, and also had a chance now to have a look through your book, Why Buy Bitcoin. I think it's great. And I think you've got an interesting background because it's not the typical background. So tell us a bit about yourself.
Yeah, thanks. Well, if you don't mind, I want to cover one or two things first. The first is the usual disclaimer, which is none of this is investment advice, and all opinions are my own and not those of my employer, Westcap Group. So that's one. And the second thing is, I'd like to start by observing that I've noticed that a lot of Aussies do quite well in Bitcoin, and so I was wondering if an accent would help with book sales. I was thinking about Stefan Livera and Freya Hess and Alex Savitsky and the Wizard of Oz, and this guy Bruce Walking. He's this baby boomer, and he walks around miles a day, and he tweets about these podcasts he's listening to in Bitcoin. Therefore, I've been working on the accent. So I've been working on saying things like give Bitcoin and buy Bitcoin and save Bitcoin and stake sets and Orange Coin Good. number go up.
I'll tell you what, your
Yeah.
accent is it's sounding very close to the Kiwi New Zealander accent. Yeah.
Busted. The funny thing is I have been to Australia, but it was over 20 years ago. But I did go to New Zealand, and that trip was more recent. So I think I failed anyway. Yeah. So quick background on me. Grew up in LA, went to school in Massachusetts, started my career on Wall Street, worked for Goldman Sachs doing investment banking, and I did private equity next. And then I worked for a hedge fund in LA doing a wide range of stuff, distressed debt and equities and private debt and private equity. And I was on Wall Street before the financial crisis, and then I was doing the investing after the financial crisis. And then I joined my family firm, which does wealth management, and that was 7 years ago. And I got I got excited basically about growing that business and helping out clients rather than investing for faceless institutions. And so that takes me to today. And obviously that doesn't talk about the Bitcoin part, but I'm sure we'll get to that.
Excellent. And I find that interesting because in Bitcoin, it's arguably, you could say, at least in the first few years, it's been very retail, just individual level hodlers driven. And, over the last few years, there's been a bit more of talk of the so-called institutional money and so on. But in some ways, I actually prefer talking to individuals and treating it like a bottom-up revolution. Tell us a bit about your work as working. You're a CFA and a CFP and working at Westcap. Tell us a little bit about that and how you've been teaching your clients about Bitcoin.
Yeah, sure. So I get it, man. I think the grassroots, sound money perspective is actually the most important one. However, for Bitcoin to reach its potential, it has to get adopted. Well, I shouldn't say it has to get adopted as an investment, but I think it would help an awful lot. So there's that piece. I come at it from both angles, right? I'm a big believer in sound money that is uncensorable and hard to confiscate. And but yeah, I'm also an investor. So explaining it to clients, the story of the book was I knew I was going to have to explain it to clients after I'd figured it out as a fiduciary, right? I'd figure it out. Oh, okay, this is an investment that has huge potential upside, and when I probability weight that upside and compare it to the price, I say, wow, I gotta own this, and anyone should own this at least a little bit. And so then I got to explain it to clients. And the first conversations I had were, let's say, challenging. Most of my clients had, knew what was in the mainstream media, which is the usual FUD and the bad coverage and literally, factual errors that the most of the mainstream media serve up to us. And so, yeah, it was a challenge, and the book was in large part an effort to create something that I could push to my clients and say, look, I've thought really hard about this. Please read it because it's very readable. And after you've read it, let's talk about it.
Yeah. And also, in terms of coming from the Wall Street world, were you already into Austrian economics and more like a free market libertarian yourself? Or was that kind of a journey that you went on while learning a bit about Bitcoin?
I wish, Stefan, where were you a few years ago when I needed you? The answer is actually you were doing your thing and educating people before almost anybody, at least in this format. No, I had no Austrian economics. I wish that I had exposure to that stuff. I was born and raised a Keynesian. I was an econ major in college, and God, I wish I'd had that education. And so, yes, Bitcoin was the forcing function for understanding what is money, and therefore delving into the Austrians.
Yeah, and that comes through in your book as well, because you talk about Karl Menger and some of the Austrians like Mises and Rothbard and so on, people who I mention on this podcast almost every episode, right?
That's right.
But I found that interesting as well, because some people come into it and then they learn about Bitcoin and then that's their reason for learning about some of these other things that they would not have seen otherwise. So can you tell us a little bit about that? And do you find that a challenge when you're speaking to your clients, because they may not have learned about these ways of thinking either.
Yeah, it's definitely a challenge. My experience is that very, very few have had any exposure at all to the Austrian school, and that's unfortunate. So, yeah, it's an uphill battle in that regard. I certainly can't tell my clients to, stop everything and go read Human Action.
Of course.
That's not going to fly.
Yeah.
So, yeah, I do my best to summarize. I think the good news is, and some of these stats are in the book and the graphs, right? When you approach it from just, the ratio of debt to GDP, right? Just debt levels in general. And you argue that, okay, maybe this can't literally go on forever. That's at least a reasonable, I think, starting point. That would have been a really hard argument, I don't know, a decade or two ago. But now now I think it makes more sense to people. But yeah, man, it's an uphill battle. People have not been exposed to Austrian economics, and I applaud the work that you do and that others do in that regard.
Well, thank you for that. And I think of this when I was thinking, okay, I've got to get Andy on the show and talk about his book. I think some of this material, in some ways, is like a continuation from one of my earlier episodes with Preston Pish, episode 109, where, again, he's coming from an investor perspective, and the typical investor is thinking, okay, but what's the yield on this thing? Where is my dividend, or what is my interest income from Bitcoin? And Bitcoin doesn't have any of that, so why would I buy it? And so what's the typical way you would explain that to someone coming from what we might say is a traditional investor mindset?
Yeah. So I'll talk about my personal journey. And so I was raised, I guess, a value investor. And so this notion of something that doesn't generate cash flows having value is was anathema, basically, right? And it was anathema, actually. Hats off to my former coworker, colleague, Matt Fair. He some years ago, tried to pummel me with some good arguments about sound money, and particularly gold. And it didn't really sink in, but I think he probably sowed some seeds there in my mind. It was 2016 when I started paying attention to some of the more capable major macro traders like George Soros, like Stan Druckenmiller, and they were going long gold at the time. And I thought to myself, okay, that's interesting. Like, these guys are way smarter than I am. They have better investment track records than really anyone in the investment business, including Warren Buffett. Maybe I ought to pay attention to these guys. So that was the point when I did some homework and started to understand the value of sound money and the possibility that something that didn't generate cash flow could accrue some value. And that's actually when we first got our clients involved. So interestingly, my firm is now over 30 years old. I haven't been there 30 years, right? My father and his co-founder founded it that many years ago. But never in the history of the firm had we invested in gold until I brought it in 2016. And it was a small position, but over time, actually, as I paid more attention to the Austrians, including through my learning process with Bitcoin, I then started sizing up the gold position, as well as taking the Bitcoin position. So I don't know if that answered your question, but that's kind of how I came at it. Oh, well, actually, so to your question about, how do you explain it to people? It's hard. I mean, I actually do use the simple Menger framework of three kinds of goods: consumption good, capital good, monetary good. And the monetary good doesn't generate cash flows, and it doesn't generate utility except for the utility of transacting. And I haven't come up with a better way of explaining it than that. You probably have. I'd like to hear how you pitch it.
Well, I mean, that is the canonical Austrian way of thinking as well, because you've got consumer goods, which are things that you consume right now. You have capital goods, which are used to make those goods. And then you've got money, which is sui generis. And I remember discussing that in episode 15 with Stefan Kinsella as well, where we were talking about this idea that Mises spoke about money as being sui generis. It's one of a kind. It's unique. It's not meant to be like the other things. And so I think that's basically the typical way I would answer that question, which again, it might be difficult to articulate to somebody who's coming from a traditional investor mindset. And so let's move into the characteristics of a good money, because this is one of those things where you can find lots of different articles or essays or books that have different, I mean, it's kind of like people just have their own way of coming to the same conclusion. But give us your ideas on how you spell out what makes a good money.
Yeah. So I have, unfortunately, I have 14 of them. And one of my personal sort of frustrations with learning about Bitcoin and learning about money in general was people were talking about, I don't know, 4 or 5 or 6 or 7 characteristics of money. And I couldn't get my head around there being less than 10. And I thought really hard about it. And I came up with this list. And so the list is identifiable, transferable, durable, divisible, dense, scarce, short-term stable value, long-term stable value, fungible, unseizable, censorship resistant, private, required for some important purpose, and then backed by a powerful agent. And I can talk about any of those, but I think it's important to note that each of those is important. They're not necessarily equally important, and no form of money scores well on all those characteristics. By the way, none of those is binary, right? They're each sort of a continuum, a sliding scale in their own right. And then, of course, different people value different characteristics, more than others. So there's a lot of shades of gray in there. But those are the 14 that I came up with. And I'm interested in your perspective on whether any of these are illegitimate or whether I missed any.
So I think mostly that all sounds. It all makes a lot of sense to me. I think it's almost just like you're coming at it from a different way of explaining, and perhaps you're putting it into the context for a person living in 2019 or 2020 of this is how you can think about money. The only one I'm not quite clear on is and you might know this as well, the backed by a powerful agent part. I'm not clear on why that is kind of needs to be an important characteristic of money. But what's your view there?
Yeah, my view, my view may be skewed by the fact that so many people today talk about the primacy of the dollar, and then they talk about being backed by the US military, right? And I think that's real. I mean, I do think that the history of geopolitics and conflicts, wars recently fought by this country, over the last several decades, indicate that countries, you think about the petrodollar, right? Countries are more willing to, let's say, use the dollar, denominate, oil contracts or other economic arrangements in the dollar, in part because if they don't, the jackboot of the U.S. is going to come down on their throat. So I would say that's my perspective on why the backing of a powerful agent, and in the modern era, that's the U.S. military, is important.
Right, I see what you're saying. And I think that, to me, I'm thinking more from, so coming from like an Austrian perspective, I'm thinking of, say, Dr. Joseph Salerno and his explanation on sound money. And part of his explanation is actually, being free from government interference, right? And so it's kind of, and again, it's not like bringing an ideological blinder to it. It's just saying, looking at it from a value-free sense, what would people choose? And I think even if you look back at Menger and so on, he would spell out, okay, what were some of the political or social impositions upon what we use for our exchange and our consumption? Because if there was some kind of big societal taboo about using a certain thing, then maybe that wouldn't be the money that we choose. And so I think to some extent, maybe this kind of backed by a powerful agent, I think maybe that part is it sort of bends and shifts a bit. And with Bitcoin, again, as I'm sure you are aware, it's like this asymmetric defensive technology. And the question is, over time, will that be proven out to be enough of a defensive technology that you don't need a backing by a powerful agent?
Yes. No, I like that framing a lot. I mean, there's no question that if you return to first principles about, what is the best money in a vacuum, right? Then I agree with you 100%. And I agree with you about those, those guys and their perspectives. Like, starting with a blank slate, what would be the best money? And so the backed by a powerful agent, it's only relevant because of, I suppose, because of the network effect factor and this ability of some power to, impose this system after having left the gold standard. There's it. If the U.S. military didn't exist in its form of the last few decades, there's little doubt in my mind that the dollar's primacy would have been, significantly impacted, and perhaps we would have moved on to something else. I don't know. Perhaps we would have moved back to gold. Perhaps we would move to Bitcoin more quickly. So yeah, it's this sort of it's this sticky human and government created thing that causes us to, or let's say delays us from moving toward the absolute best money. And we arguably would have had a faster transition if not for the existence of this factor.
Yeah. And I think it's a fair point that you were saying here, like in that stipulation, you're saying if there weren't a US government military, but then let's also remember that if it wasn't the US government, it might be some other government. And so it's kind of like, it comes down to what technology do humans have that enables them to defensively protect their value against an outsider inflationist or an outsider controller, let's say.
Agreed.
Yeah. And so...
yeah, go ahead.
Yeah, go on.
No, I was going to say, because you made a point about, how this newly hard to control and unconfiscatable asset, is better money. And there's no doubt in my mind that it's better money. I mean, one of the things I do in the book is I score the dollar and I score gold and I score Bitcoin as they exist today in my, as I see them. And then I score Bitcoin basically in the future. In other words, how it's developing over time and the direction it's likely to go. And Bitcoin clearly, has characteristics that are head and shoulders above both gold and the dollar. And, we could delve into those, but it's also catching up on some of the other characteristics as time goes on.
Yeah. And I also think it's fair to point out that the situation has changed over time. So when Carl Menger was writing in the 1800s and Mises was writing in the early and mid 1900s, they would not have foreseen the things that the US government would later come to do, or that gold became somewhat neutered by the government because the way it's stored is very centralized. And so I think that's also an important factor as well, that people have to be cognizant of the historical situation that the world was living in and what were the typical ways that money got controlled.
Yeah, agreed. Which is, and if you invert that, it makes it all the more amazing and impressive that the framework that they applied or that they created, so many years ago, still basically, governs, I would say, right? I mean, I haven't found much. I mean, like I say, I can quibble about sort of what are the characteristics that they identify versus the ones I identify, as you say, in a world where new characteristics are possible, or characteristics that didn't exist then, could exist today. But yeah, the basic framework they laid out so many decades and centuries ago is, still governs. These guys were brilliant. No wonder you've been studying them for so many years. I wish I'd found them earlier.
Don't we all? And I think the other big one that comes to mind, and so this is a very common question, but isn't Bitcoin volatile? And so in your characteristics, you've got two there. You've got short-term stable value and long-term stable value. So what are you getting at with that?
Yeah, I think this is an important distinction because people, as you say, they really get hung up on this all the time. And yeah, so here we go to the question of what is money, and I go to the medium of exchange across space and time. And the medium of exchange across space is, the actual transacting in real time. And then the medium of exchange across time is the store of value concept. And that's where the bifurcation exists. You say, okay, the store of value, the medium of exchange across time, is the characteristic of not getting inflated away over time. And that's where things like gold and Bitcoin are strong and the dollar and fiat currencies are weak, versus the medium of exchange across space, sort of in short-term time, is the short-term price stability characteristic, whereby things don't get repriced all that frequently in dollars. The price of the sandwich today is more or less the price of the sandwich tomorrow, even if it goes up over a period of a year or a few years. And that is an important distinction that people get hung up on. I would say most people get hung up when they discount or they downplay the moneyness of Bitcoin, or the ability of Bitcoin to realize the potential of becoming the world's money. They focus on that short-term price stability. And that's actually one of Bitcoin's weakest characteristics today, in my opinion. It is that short-term price stability. And I believe that we will, if Bitcoin realizes its potential, if and when, which is probably 2 orders of magnitude away on price, right? Then we'll have more stability. I do think that because of the limited supply, it'll never be as stable as, quote unquote, stable, short term stable as the dollar. It's got likewise the same thing with gold potentially. It actually could become more short-term stable than gold because it becomes so much larger than gold. But yeah, that's kind of the framework that I apply.
Yeah, and I actually think in some ways, because the supply is more predictable, it might actually become even more stable and more predictable in that way. But I think in some sense, it might just be that it's like central banks try to hide a little bit of the danger and the volatility, and at the risk of creating like the more big, black swan kind of volatility. And I think if we were to, let's say we did live under a Bitcoin standard, maybe it's more just like we would more accurately perceive the little supply shocks and natural emergencies or disasters that occur and so on, that change maybe people's propensity to hold money and so on. But that would be almost more like a true perception of what consumers demand to hold money is. So that's,
I think that's
one
interesting.
idea. Yeah.
I think that's interesting. You're right. It could be more true and more real. And I guess the question, are you suggesting that it would therefore be less volatile, or you're just saying that it would be a more accurate reflection of, human action, basically people's preferences?
Yes, a more accurate reflection of human preferences. And I think to some extent it's like these central banks and these governments who intervene into money, they're kind of selling us this false promise that, let me control the money and I'll keep it stable for you guys, when it's more like, no, actually there is no such thing as monetary stability.
Yeah,
so that's how
I tend to agree.
Yeah.
I mean, you go back to the question of, price gouging and, volatility in times of scarcity and shortage. And why not apply the same to the monetary good, or I guess consumption goods as the inverse, or the other side of the exchange rate with money? Yeah, why shouldn't prices be more volatile? If more people want to buy the particular consumption good or capital good, this price should go up. And if the next day not as many people want to buy it, its price should go down. I'll buy it.
Yeah. And so you're also involved with, professional money management. Another important aspect of that is returns. The only, let's talk about returns that you can eat, meaning after taxes and fees and so on. So I think taxes is an important one, because you're in America, that has a capital gains tax. I'm in Australia, there's a capital gains tax. That will, at least in the short to medium term, impact the ability for people to use Bitcoin as money. But what's your view on the tax situation and potentially how that changes maybe over the long term?
Yeah, tax, I agree with you entirely, is one of the bugbears that we're dealing with right now with the monetization of Bitcoin. I guess I could look at it a couple of ways. The way I present it in the book is, I ask the question, is Bitcoin money? And yes, Bitcoin is money. But on the other hand, as an investment, it is an investment in an asset that is becoming money. In other words, it hasn't fully monetized. By the time it does fully monetize, well, then the value will be much higher. So, am I that focused right now on making sure that people can transact and buy a cup of coffee? I'm not that focused on it. I do think it has to happen ultimately, but I think it would actually sort of be okay, if it's years from now. It would be great if it happened sooner, of course. And there's no doubt that there's no doubt that tax and tracking tax is an impediment to, current, medium of exchange use today. It would be it's interesting and unknowable, right? We don't know the counterfactual. Well, maybe we do. I guess there are, isn't Germany, I'm trying to remember. I think there are some countries where it's basically not, taxable as a capital asset.
Right,
But
Singapore, Portugal, Switzerland, Germany, if you hold for more than 1 year. There are a few off the top of my head that I know of.
yeah, there you go. So I guess you could it would be an interesting study to compare consumer behavior in those countries versus here. Like, are people actually using it to transact today? I suspect that the transaction volume isn't that much higher in those countries yet, because of what you know and what I know, which is that the potential value of this thing is so much higher that, I'd be crazy basically to part with it. I'd rather just hodl strong. I'd rather just hoard it. So yeah, I think it's a problem that has to be solved in the long run, and I hope it gets solved soon. But if it doesn't get solved soon, I don't know that it matters all that much for this phase.
Right, exactly. And I think if you project out into decades in the future, if it really does become commonly used money, well, then I think governments of the world will have to change the tax rules around it to not treat it like a capital asset every time you spend some of it, right? Because then it just becomes completely unwieldy for anyone. So, yeah. And also, I think when we're thinking of traditional investment, right? So I like to read a lot of personal finance books, so maybe not so much nowadays, but I used to read a lot of those. And some of those books would talk about, if you read, say, Bogleheads, or some of these books about, buying into ETFs and stay the course, right? Just buy and buy. And I wonder how much of that is being driven by central banks pushing asset prices continually up, such that a lot of the traditional investment world are just thinking, oh, well, just keep buying, and over the long run, it'll just keep going up anyway. But how has coming into this whole Austrian rabbit hole changed your view there?
Yes. So in 2016, I put out a memo to clients saying, based on where valuations are today, you should expect significantly lower returns in the future than you have in the last several decades. So, and I still believe that. So that tells you that, yeah, I agree with you 100%. There's no question in my mind that money printing by all the central banks, especially the Fed, has flowed into both capital assets and consumption goods. And then the problem, well, I shouldn't say the problem, but the countervailing force there is no countervailing force in capital goods, in capital assets, right? So stocks go up, real estate goes up, all risk assets are driven by that money printing. And then on the consumption goods side, it's more complicated because yes, you have money printing, which some of which is no doubt flowing into those, but you've got the countervailing, forces of automation and free trade, at least until recently. So there's been several factors that have been holding those prices down. But yeah, I agree with you 100% that when you look at people who are saving and investing today and thinking, well, and looking at recent history and saying, oh, wow, just indexing, basically buying the index has made tons of money. That is the dangerous trap of extrapolating the past into the future. And yeah, people really ought to be careful about that, and they ought to have significantly lowered expectations about future returns in both equities and real estate, especially compared to the past, for sure.
Yeah, and I think it just is a difficult thing to try and explain, because people who've tried to call tops have, over the last, let's say, 7-8 years, have consistently been wrong. Because up until now, it's just been continually rising higher and higher, and then the opposing view might just say, "Oh, look, you guys are just perma bears. You guys don't understand. See, the central bank is riding to the rescue." Yeah. How do you think about timing, and is it just essentially sizing of your position? So, is that the way that you try to manage that?
Yeah, it is sizing of the position. So we're global asset allocators, and anything that's publicly traded, for the most part, we own for our clients. And then the question is, what's the allocation? Do you overweight or do you underweight? Do you ever go to zero on any asset? And we're reluctant to go to zero on just about any asset, except for when it's, extraordinarily, obviously overvalued. And so, yes, at the margin, we adjust. And so we adjust over time toward assets that are cheaper in our estimation, and we just away from, or we rebalance away from assets that are more expensive. But as you pointed out, you can have very long periods of time where a particular asset class significantly outperforms others, and it's durable. It's like, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 years. It's been interesting. US stocks, especially large US stocks, especially, the internet giants, have crushed all the competition in terms of performance for literally a decade now. It's been dramatic. And so, we wish that we could foresee those assets that are going to significantly outperform over literally, half a decade or a decade of time. That's extraordinarily difficult to do. So yeah, we remain diversified and we size according to expectations. But you can, it's been a tough period to be a globally diversified investor, right? If you're an American, you would have been better off just buying and owning the S&P for the last decade.
Right. And then that's also a funny feedback loop there, because if you are a professional wealth manager and you quote unquote did the right thing, but you made less money than, say, some other wealth manager who quote unquote did the wrong thing, then customers will switch over to that money manager. And so that's kind of a difficult conversation as well, that I presume you must be having as well, that's a general problem.
That's right. Yeah. People chase performance. They look at recent history. People they have difficulty looking at longer time series, right? They have difficulty thinking about, this is probably the single biggest reason why there hasn't been a crack up boom, let's say, to use the Austrian term, yet, at least in modern history or recent history, is because people do extrapolate. And so a reasonable analyst, and there are some who've been noticing that debt levels are too high and that they already were too high, last year and 5 years ago and 10 years ago, have been saying, that the crash is going to come. Well, if the rest of the population just extrapolates, like lemmings, they look at the past and then they keep rolling, and there's enough dollars, or there's enough asset value that continues on that march, well, then we can suspend disbelief longer than we think, right? And yeah, I think that's arguably where we are. I think that's where we are.
Yeah, and so it's a funny thing because a common example I mention sometimes is we knew communism is a terrible system, but USSR still took like 6 decades, right? So It's kind of, you can't call a top because you just never know exactly there are so many variables and so many moving pieces here that you can't just say, okay, 2020 is the final one. This is it, guys. It's coming now. And it's right. Well, you don't know.
I like one of the frameworks I like, by the way, is by Ben Hunt from Epsilon Theory. He's been on top of the coronavirus stuff lately, and also on top of let's say troubling trends in the last few years that people have been paying attention to. And the framework he uses is what he calls common knowledge, which is it's not what everybody knows. It's what everybody knows that everybody knows. And when you talk about communism, you talk about, okay, people, arguably a significant portion of the population, knew it was a bad system and knew it was BS and knew that it wasn't the right system to maintain. But until you had a critical mass of people realizing that the emperor had no clothes, it just perpetuated. And so, and this explains, number one, why these bad systems can persist for so long. And number two, why the tipping points are, can't be anticipated in advance, because there's this phase shift of people looking at each other and realizing, not only do I realize that the emperor has no clothes, but you realize it too. And enough people realize it. So, now it's revolution, or now it's, regime change. And that's human nature. We're social animals. And that ability to tell stories that aren't true and perpetuate untruths is useful when it allows us to galvanize in a particular movement and move the team forward and conquer where we otherwise wouldn't be able to. But yeah, it can be troublesome and pernicious, and it can allow basically negative frameworks and regimes to persist longer than they should.
Right. And yeah, it's a great way of spelling it out. And I think it's very much like that idea that people talk about, gradually, then suddenly, right?
Yes.
And so I think I was joking about it a little earlier, but how people were all, because of coronavirus and all these people were panic buying toilet paper. And I was joking that, someday a day will come when people panic buy Bitcoin way harder than they're panic buying the toilet paper, right? Because it'll just hit a point, but we can't say when. So
yeah, I think that's right. I had mixed feelings about that point. Yeah, that's the hyper Bitcoinization flashpoint, and it may happen. And part of me hopes that it does, and soon, and part of me hopes that it's more gradual, because that may be better for the average person. But yeah, it's very possible that you get that sort of speculative attack, as Pierre Rochard suggests, and we'll just have to see.
Yeah, right. And so look, I think you and me and most of my listeners would agree we're in an unsustainable situation. So we've got this massive debt problem. Governments all around the world, the US government has a massive debt. What are some of the potential scenarios? And you spell out some here in terms of the fiat endgame. So what are some of the scenarios that we might
that's
surmise?
Right. That's right. So I've got a menu, the menu of bad options for resolving the debt problem. And I have six items on the menu. So item 1 is austerity. Well, first I'll just list them. So item 1, austerity. 2 is mass defaults. 3 is jubilee or debt cancellation. 4 is redistribution. 5 is financial repression, and then 6 is inflation, consumer price inflation. So I'll just go through them. So austerity, also known as belt tightening, basically means cutting consumption and not living beyond your means. And this means that you can actually save and you can reduce the debt burden over time. Unfortunately, this is painful. Nobody likes doing it. It's like dieting. It usually fails. And we've seen governments attempt it, and it almost never works, mostly because of politics and the fact that politicians are elected on 2 and 4 and 6 year cycles. And if, as a politician, you don't deliver the goodies, somebody else will get elected that will. So, the sort of the modern case that's interesting to watch, I think, now is Greece. Greece has been in a recession/depression, since 2011, basically. I mean, yes, it's been better the last few years, but they've actually sort of stuck with austerity, and we'll see if they continue to. I kind of doubt that they will. I would argue that the only reason, that they haven't printed money and devalued is that they're in the euro. But for the most part, yeah, austerity doesn't work. People can't stick to it. So option 2 is mass defaults. And arguably, this is as painful as austerity. Anyone who holds debt as an asset loses value. It's great if you're a borrower, but if you're a lender, a default is terrible. And we saw this play out more or less in the Great Depression, and that's why it won't happen again, because politicians and economists, know how that turned out, and it was terrible. And it's unlikely that we'll tolerate mass defaults.
Yeah, let's explore that one just for a little bit.
Sure.
So when you've got this mass default situation, and I guess think through like the typical retail bank, right? They've got a lot of home loans on their asset side. And then what happens when there's mass defaults? It means that bank's assets are massively just credit collapsing.
That's
What's
right.
What's the scenario then?
Agreed.
What does it look like?
Yeah. So in this fiat money system that we've got, most of the money, quote unquote money, is actually bank debt, right? It's yes, you had $10 of cash deposits of M0, into the bank account, but then the bank, lends 10 times as much against that cash deposit or that cash reserve. And so, so there's huge leverage in the system. And as you say, if there's if mortgage borrowers, can't pay their mortgages, then the bank isn't getting paid. The bank can't lend money to new borrowers. Also, the bank can't lend money to companies. Companies face maturities on the debts that they got to pay. They can't refinance. So they fire people, and people, can't pay their mortgage, and you get this multifaceted feedback loop, or the spiral, downward, which is a deleveraging, in which basically everybody gets hurt, both on the asset side and the borrower side. Yeah, it's ugly. It's
Right.
not.
Yeah.
It's not fun. You get bank runs. You get mass unemployment. Yeah, that was the Depression. That was the 1930s.
Right.
So
And yeah.
go ahead.
Yeah, I was just saying, and then like I guess from an Austrian perspective, you would say, well, that's going to rehab, that's the readjustment. And so while that may be, temporarily painful for many people, it's kind of like we have to go to rehab, right? But unfortunately, it's sort of like we've got a drug addict and they don't want to go to rehab. They just want to keep getting more drugs, right?
That's
And
right.
so,
That's right. And I would agree with you. I mean, it may actually be the right way to atone and cleanse and basically get on the right path, but because it's so painful, and because it may be in the power of politicians to avoid that outcome, they will avoid it.
yeah, I think so as well. So it's one of those things where it's politically unlikely to happen that way. So
Exactly.
what's next? You've got a debt jubilee next.
That's right. Debt cancellation, or jubilee. The jubilee term comes from biblical times, and it comes from this idea of when there's a new ruler, there's a new king who ascends the throne, and in celebration announces the cancellation of debts across the kingdom. And this is great. It curries favor with the average subject, because the average subject is a debtor, not a creditor. And this kind of looks similar to mass defaults, because if one man's debt is another man's asset, then anybody who is a lender and now gets this debt extinguished, feels a lot of economic pain. Most of those lenders tend to be wealthy folks who are also capitalists. They're industrialists. They're the people who run companies that employ people and have equity value that depends on that credit system. So similar situation. Basically, it's significantly disruptive to the economy, and it's especially problematic because if the sovereign can just declare a debt null and void, well, that puts a real dent into the confidence of ideas of rule of law, contract law, and property rights. Because if the ruler can just sort of capriciously say, oh, this debt contract is now null and void, well, then as an entrepreneur, you're saying to yourself, what are my real property rights? And am I actually going to be able to capture the fruits of my labor and the risk that I take? If this guy who's in charge of the kingdom can basically just change the rules on me. So yeah, very problematic.
And I'll tell you one reflection as well on that, and just adding to that point, is something I've seen Nick Szabo speak about, which is deep safety versus shallow safety. And so one of the points that I've seen some people on Twitter saying is, oh, didn't you Bitcoin people say it's a safe haven, blah, blah, blah. But I think the best answer on this is to think of Bitcoin as deep safety. And what's deep safety? It means think about the underlying institutions that you are living under. And if in your example, the king can just unilaterally declare, oh, that it's a debt jubilee, but Bitcoin is not like that. And Bitcoin gives you some kind of protection against that, doesn't it?
Yeah, I like that. I like that framework a lot. I like the deep safety. Absolutely. If most assets in the economy depend on rule of law, and depend on contract, and depend on the, let's say, fair behavior of those in power, then yes, Bitcoin is this uniquely this system that is uniquely resistant to malfunctions in that other established regular way system. Totally agree.
Yeah. So and then the next one you've got here is redistribution.
Yeah, that's right. So we just finished items 1, 2, and 3. That's the top of the menu. Now we're getting to the bottom of the menu, which I think is where we're more likely to order from, so to speak. Redistribution is just tax and spend, right? It's taxing the rich more in various forms. That can be higher regular income tax, can be higher capital gains tax, it can be a wealth tax, it can be any number of things. The wealth tax is a conversation that I have with clients with some frequency. They're like, a wealth tax, that'll never happen in the US. And I say, I hope you're right, but we'll see. So yeah, I think that when you look at the political conversation today, we're in an election year. I don't know what the outcome will be. However, if either you get a Democratic victory and or a Democratic sweep in this election, for sure we'll see higher taxes. If that doesn't happen, maybe it's not this cycle, but I have some confidence that in the next cycle or the one after, we're likely to see more tax burden on the wealthy and redistribution to the less wealthy, taxing the haves and giving to the have-nots.
It's very soak the rich style, and we're seeing a lot of popularity for politicians who come out with that kind of idea. So definitely one to watch over the next 5 to 10 years, let's say.
Yeah, no kidding. Absolutely. So the next, fifth category is financial repression. This is a term that was coined by two Stanford economists, Edward Shaw and Ronald McKinnon, I think in the 1970s. And it describes, a set of government policies that primarily includes, lowering interest rates and thereby penalizing savers, right? And so, however, capital being mobile, it often needs to be coupled with capital controls, right? That's somewhat what we see in China. Interest rates on bank accounts in China still are and have been extraordinarily low. One of the results of that is you get, capital shifted to other parts of the economy, like you get a, property bubble, a real estate bubble. But in the case of China, the capital controls have been, let's say, somewhat effective. Now, of course, you don't need capital controls if all central banks financially repress and lower interest rates at the same time, right? I mean, you look at the situation we're in with Japanese interest rates being zero or negative, with German and several other European countries, being zero or negative, and then now most recently with U.S. rates approaching zero. We're not there yet, but we're pretty close. There's sort of nowhere to hide. But yeah, that's the financial repression situation, and lowering rates that way does for a while allow governments to borrow more and run deficits and basically play out this house of cards for a much longer period of time than they would be able to if they didn't have those tools available to them.
Yeah, and it just kind of reminds me that we should expect that governments will try to keep doing what they can to keep the party going. And so I think that's probably the intuition there. And I think coming to our next one, which is consumer price inflation, I think that's also another very much in line with probably a very likely scenario. So tell us, what does that scenario look like?
Yeah, so this is the consumer price inflation scenario is the one that I think is most likely. And by the way, I'll say that these six scenarios or outcomes are not sort of mutually exclusive. My best guess is that we have a combination of the last three, right? We have tax and redistribution. We have financial repression. I mean, clearly the financial repression is ongoing with low interest rates and falling interest rates. And then the eventual outcome is likely consumer price inflation. And so when we think about, okay, how can we reduce the real burden of debts? Well, other than, cutting them and slashing them outright in those methods we discussed earlier, the sly, I hate to say sly and roundabout way, but I'll invoke that term. The slightly more sly and roundabout way of reducing the debt burden is just by printing money and reducing the real burden of those debts by inflating everything else over time. So that seems most likely to me. We haven't seen significant consumer price inflation generally across the world, at least in developed countries and rich countries for decades now. And I think that's in large part because of those couple of factors I mentioned earlier, like automation, like free trade, um, which brought very cheap labor and therefore lowered costs on consumer goods. And then there's also the issue of, well, what is the real level of inflation, and that's a whole other can of worms, which I discuss in the book. Primarily those couple areas of consumer goods that are also quasi capital goods, like education and especially like housing, where yes, inflation as measured and declared by the government is low in housing, but although rents have been kept low because interest rates are low, and therefore, real estate can be acquired. Well, can be acquired, and you can support that level of capital with a low rent. It also jacks up the value of the asset and prices a whole generation out of the ability to buy that asset. And so, yeah, it's great news if you're a renter. It's terrible news if you ever want to not be a renter and actually own your home, right? And this is what millennials are figuring out and living right now, is their inability basically to climb onto the property ladder, because the average home in a city is multiples of income. It used to be 3 or 4 times annual income, and now it's 10 times annual income, and it's out of reach. So yeah, so that's what I'd say about consumer price inflation is. And by the way, for my clients, the major one of the major adjustments we've made in our portfolio allocation is to account for this, right? And that's the for the first time investing in gold a few years ago, and continuing to add to that position in the last few years, as well as adding a small amount of Bitcoin. And in my estimation, we're more likely to add to that position over time rather than subtract from it.
Right, yeah, and it's the thing. Again, this is one of those things where, again, the doomsayers and like the perma bears and so on can come out and say, "Oh, look, we're going to have high inflation and stuff," and maybe they were a bit early on that call, right? Not just a bit early, but
yeah.
And in reality, what we've seen is asset price inflation, and as you said, housing prices just get out of reach for people who are in the millennial or younger generation, and then it just is more like that's an eventual outcome, right? You just keep on this track. Well, that's eventually what will happen, but no one really knows exactly when that tipping point happens again.
That's right, and this gets to the well, as investors, this gets to the portfolio management question. If I could anticipate when that inflection point in inflation is going to occur, man, I could make a lot of money. It's unknowable. It really is unknowable. I will say that my confidence has grown, especially recently. And I wrote about this in the book. So the Fed has this 2% inflation target, and by the way, it's 2% as they measure it. And as we know, as we just discussed, there are several reasons why their measurement is flawed. Nevertheless, the Fed has, according to their own math, been undershooting their inflation target of 2% for years now. And they actually went on record last year. It was May of last year. And they specifically published a note talking about how the inflation target is quote unquote symmetric, right? What do they mean by this? They mean that for every year that they undershot the target, it would be okay if they overshot the target, right? So they've already told us, it's in writing, right, that they're okay with higher than 2% inflation. Now, we don't know when that'll happen. We don't know how much higher than 2% they're comfortable with. But when I look at the debt burden and I think about, what's the likely path out of this thing, and I read this in the book, I think we see 5 to 8% consumer price inflation before we see any really serious follow through attempt to raise interest rates. Because if you quote unquote normalize interest rates, right, if you get to 7-8%, on a 30-year mortgage, and you get to, I don't know, 5% on the treasury, on the 10-year treasury, it's going to be a very severe recession. So central banks, when put to that, trade-off, they say, deep recession or a little higher inflation when we've already been undershooting, our inflation target? We'll take the higher inflation.
Right, and it's the more politically palatable option. It's the one that makes them more popular. We should anticipate that that is the option, that is the pathway that they would preferentially choose.
That's right. And nothing is 100%, right? We only think in probabilities. But when I look at that menu of bad options out of too much debt, I think that clearly the inflation option is the most attractive, for the powers that be in government.
So let's say the listener now is they're convinced about this idea. They're thinking, okay, maybe I take a small position in some Bitcoin. What are some typical ways you would say when you're thinking about position size for Bitcoin?
Yeah. So I still stick with the rule, which actually applies to every asset in which you invest, which is don't invest any more than you can afford to lose in a single asset, because any asset can go to zero. There are those who will argue against that, but the reality is any asset can go to zero or near zero. So that rule is no different for Bitcoin than anything else. So that's one piece. And then the second piece is, well, how much do you need basically to have a hedge? We've started small with clients. I mean, we've started under 1%. There's also then the layering on of the psychological element, which is people do struggle with the volatility, the short-term volatility. They really have difficulty getting their head around the possibility that this asset may have legs in the long term, despite the fact that it sometimes loses 80% of its value, right? Or 80% on price. So these are the factors that, that we consider. And then, of course, you look at the data is in the book too, about the last, 10 years of performance. And historically, you've been able to add, 2 to 3% annual return with to a portfolio, a diversified portfolio with a very small allocation to Bitcoin. So those are some factors. I mean, it's clear that zero is the wrong number. And, for many people, it's, 1% or a little less. And then for those who are comfortable with it and understand it and can get past the, just the negative perceptions and all the FUD and, the Mt. Gox and the money laundering allegations, which are false. But for folks that can get past that, then, several percentage points can make more sense. I'm talking about, for clients now. And then for those who have really done the research, I see people on Twitter who are all in and levered. I definitely don't recommend that. Leverage is problematic with an asset that can on occasion lose 80% of its value. You really don't want to get liquidated, and you really want to have enough cash and income, to support your ongoing expenses without having to sell that precious sweet Bitcoin. But that's what I'd say.
Sure. Yeah, no, I think that makes a lot of sense for considering the type of clients that you would have. I think the other thing that's important to hit as a topic is recognition of what Bitcoin is, right? It's not the same thing of like just put it in like the ETF and just hold it. Like part of it is really appreciating it as a bearer asset as well. So what are your thoughts there on teaching that aspect to people?
So I think that's important. So there's two answers to that. There's what am I doing today for clients and what might I do in the future? So today, we hold Bitcoin in vehicles that do not entail the client holding the keys or us holding the keys, right? So it is a third-party custodian. And that is, just a decision that, hey, we want to own an inflation-proof or inflation-resistant asset that we think has tremendous upside and is uncorrelated to the rest of the portfolio. And that's an investment decision, full stop. So then there's your question of, well, what about, learning to hold the keys? I have made the offer, to my clients that, hey, I'm here to educate you and help you, when you're ready, basically to literally take the keys, right? And so I am interested in people learning to do that for themselves. I think people should be sovereign. They should be sovereign individuals. They should at least know how to, even if they don't want to do it, with all of their Bitcoin holdings, they still ought to know how to do it. And they ought to do it with at least some of their holdings, and hopefully over time they do it with more, rather than less. Having more and more skin in the game and putting, taking more and more control over time, I think makes a lot of sense. And I'm also, excited that the teaching and the educational tools in that respect are getting better. I think, in fact, that I think you've been instrumental, in fact, in that regard, putting together educational tools for people to learn, gain confidence, not screw it up, practice, and learn to securely hold their keys. And I think that's an important life skill. By the way, I'll extend this further. I had this debate actually with my dad the other day, and we were kind of sparring on this issue of can you really keep a private key safe? Can you really keep a cryptographic key safe? And my response to that is, this is a civilizational skill. It's basically a life skill for the next several decades, right? We all will have to either figure out how to do it ourselves or delegate it to someone we trust. It's just going to be something you have to learn how to do. And so, the more that we get the more that we get people comfortable, the more we educate them, the more we encourage them to play around with it, practice it, do some with a little bit of skin in the game and a little value at risk, and then step it up over time, the better. Because this is just, this is one of those things you're just going to have to learn how to do. It's like learning how to do basic math, or, learning how to write, or, learning how to code. It's just going to be a critical life skill.
Yeah, I think so. I think it's one of those things where, yes, we're not at the stage where, grandma can use Bitcoin and so on, but, right now grandma can pick up an iPad and write an email, right? And grandma needs to know a little bit about how to do an email, right? In the same way, we've got to eventually get Bitcoin custody to that point where, look, there's a little bit you have to learn, but most people can achieve it. And I think that's ideally where we want to get it to. But I think in these early days, it's very important as well to stress that idea, because Bitcoin is special, and it's important that we use it in the way that it was intended and able, and that's the way that is much more stronger as well.
I agree. I agree with you 100%. I mean, there's the question of what should the average person do, and then there is the question of literally, how many people do we need independently running nodes, on the network to keep the thing secure? And that's also very important. So I support any and all efforts, by you and others to educate people on how to do as much as possible and be as self-sovereign and supportive of the security and the secure use of the network as possible.
Yeah, of course. And I mean, for me, I'm not expecting people to go zero to hero straight away, right? It's a progression journey, and you start small and you, like you said, step it up over time. But yeah, look, I think that's pretty much it for today. But have you got any closing thoughts on, why buy Bitcoin and any other things that you think you'd like to mention?
Yeah. No, I mean, look, I'll shill the book. I wrote the book because there was a gap. I saw a gap in the market between the Bible, which is the Bitcoin standard, right, and which I love, but I wanted to write something shorter, and then some of the much shorter, more simple books, and so I designed it to tell all the pieces of the story. And explain all the pieces of Bitcoin that I thought were necessary to get off the ground, and so that's the goal of the book. And I also, obviously, like I say, I wrote it to explain it to my clients, and also to be able to hand to someone and be like, look, read this, and once you've read it, I'm happy to talk to you and answer questions. So I guess follow me on Twitter. I'm Edstrom Andrew. That's the last name, first name. The book is Why Buy Bitcoin. It's available on Amazon and Apple. And it's been a fun discussion and fun chat. And, I welcome people's feedback and criticism. Tweet at me. Tell me what I got wrong.
Yeah,
I'm probably going to regret saying that, but we'll see what happens.
we'll see. But no, I will say though, I think it's a great book to give to a person who's coming from a traditional investor mindset. Having read it, I think it would make sense to give that sort of person this book. So definitely, listeners, do consider having a look at the book and gifting it to your friends who are more on the investment side of thinking. So once again, thank you for joining me.
Thank you, Stefan. It's been great.
So share the episode with your friends who are curious about Bitcoin from that investment standpoint. Find the show notes and the transcript at stefanlivera.com/157. Also appreciate any reviews that you can leave on iTunes and subscribe on YouTube and all those things. Thanks, guys. See you in the Citadels.